Credit today is a bad risk. A lot of people in private credit have never been through a downturn. That warning came from Jamie Dimon in May 2025. He's not just making a passing comment, he's pointing to what could be the next major fault line in global finance. So what exactly does he mean? To understand it, we need to look at how the financial system has evolved. Today, public banks are under the microscope. In Switzerland, regulators are forcing UBS to raise up to $26 billion in new capital to cover its foreign subsidiaries. UBS called the demand extreme and warned it could impact investor returns or even force the bank to consider moving its headquarters. In the US, the Federal Reserve just lifted a 7-year growth cap on Wells Fargo, originally imposed after its fake account scandal. But lawmakers, including Elizabeth Warren and Maxine Waters, criticized the decision and demanded 5 years of oversight reports, claiming Wells still hasn't earned back public trust. Meanwhile, TD Bank, long viewed as one of Canada's most stable banks, is under dual scrutiny. It paid nearly $3 billion to resolve anti-money laundering violations in the US, and now Canadian regulators are reviewing its internal controls. Public banks are being closely watched. They're facing fines, regulatory probes, and growing capital demands. But while traditional banks are being boxed in, something else is growing in the shadows. That's where private credit comes in. Private credit refers to non-bank lenders providing loans directly to companies. This market has exploded. It's now worth $1.5 trillion and is projected to exceed $2.6 trillion. Investors are chasing yield. Banks have pulled back. And the result is a massive transfer of credit activity into unregulated territory. Veteran analyst Ron Insana recently warned that a crisis could be brewing in private credit. He pointed to looser lending standards, a flood of capital-chasing deals, and a total lack of transparency. Unlike banks, private lenders don't have to report as frequently. There are no standardized stress tests, and no one really knows what risks are being taken. And it's not just analysts. Executives from Ares, Blackstone, and KKR, the biggest names in private credit, have raised similar concerns. In a recent panel, they discussed over-leveraging, the risks of a downturn, and the fact that private assets aren't priced daily. When markets get volatile, these portfolios can quickly become illiquid. One of the panelists put it bluntly, "It's not just high yield, it's high opacity." This brings us back to Dimon's deeper point. A new kind of financial system is taking shape. Private credit lends, private equity borrows. Crypto moves the money. Private credit funds make direct loans to businesses, bypassing banks entirely. Private equity firms borrow that money to do leveraged buyouts and other high-risk deals. Crypto, meanwhile, is building parallel rails for moving capital, often outside regulatory view. None of these systems are backed by central banks. None are subject to the same level of regulation as traditional banks, and none come with a clear backstop in a crisis. And while these assets don't move on a daily basis like stocks, that doesn't make them safer. It makes them less transparent. The price risk doesn't go away. It just gets delayed. The real danger is what happens when investors try to exit. Suddenly, there's no market, no buyers, and losses that were invisible become very real. This is why Jamie Dimon is worried. Investors aren't just taking credit risk, they're taking liquidity risk, timing risk, systemic risk. And with interest rates still high, with the 30-year US Treasury yield near 5%, we have to ask, is private credit really offering enough to justify the danger? Yes, banks are safer today than they were in 2008. They're better capitalized and more regulated, but the financial system around them has changed dramatically. Risk hasn't disappeared, it's moved. Private credit now controls a growing share of lending. Private equity has piled on debt, and crypto is reshaping how money flows without traditional controls. So even if the next financial shock doesn't begin at a bank, it will still end up there. The system is interconnected, and the weakest point may not be the most obvious one. We're not preventing the next crisis. We may just be pushing it into a part of the system no one is watching. Subscribe to Global Notes by JP for deep dives on where risk is really building. We cover everything from US treasuries and private credit to Japan's bond market and global macro shifts you won't hear about elsewhere. Thanks for watching.